Hey everyone, happy Thursday, May 18th. It's a little after 11 o'clock on the West Coast, and it's time for another market update. There was no big data being released this week that should have caused drama in the market, but we couldn't have a week without drama these days, so instead we got debt ceiling drama. I'm sure you heard about it in the news. It's not obviously good if we default on our debt for this country. I'm not going to get into politics of any of that, but how that would affect mortgage rates is kind of up to debate. I've heard three different takes. I've heard mortgage rates would go above 8%, which is awful. I've heard that maybe things would get a little better as we got closer to default because it has in the past. And third, which I actually agree with, is it's just creating more volatility in the markets, and that's bad for mortgage rates. Bond investors tend to be a little more conservative. They don't like all this volatility. For instance, I heard that over the last year, mortgage rates have been twice as volatile week over week as they were the prior year. So just volatility is not good for mortgage rates. Bond investors tend to be conservative. They don't like all this volatility. So we want to hope for some sort of resolution, soon. What we did get in news this week, we got April housing starts and permits and the NHAB optimism index. So taking a closer look at those things, one thing to keep in mind, the household formation number in the United States right now is over 1.5 million. And these total units coming out, starts, permits, completions are all below that number. So we're kind of, making the inventory problem a little bit worse. We're not, there's no help on the way. Permits were down month over month. Our single family were up a little bit, but there were some negative revisions to past months. And like I said, doesn't seem to be lots in that will be coming to fruition over the next year or so that's going to make this inventory problem disappear. And then, like I said, we also got the NHAB housing market index. So basically how confident builders are. And keep in mind, 50 is the break-even point. So above 50 is expansion. Below 50 is things are going down. And so overall, they're above 50 finally. Current single-family sales are above 50. Sales expectations above 50. Buyer traffic still below at 33, but it's up from 20, which is back in November. And they're offering less incentives and price cuts. But still, with the buyer traffic low, but sales expectations going up, that means people that are going are buying. So builders are feeling really good about that. Builders are feeling confident. And part of that, is going to lead into the next thing is there's just not a lot of existing homes out there for sale. So it's making it better for builders. And we got April existing home sales, and they were down negative 3.4% and are down 23.2% year over year. So these are closings in existing homes. The median home price was up 3.5% to 388, still down year over year, but keep in mind that's not appreciation, and that's affected by more lower price homes being sold over the last year. Inventory, it's about a little over 1 million. It's up slightly from 980, but again, not a big jump. I think it's 1% jump. That's a 2.9 month supply. A normal market is 4.6. So we're still in a tight inventory environment. And I believe there's only 563K active listings. The rest are all under contract. So they're probably not going to go back on the market. So, a little bit less than half of that 2.9 months. And then the really interesting numbers are these two in yellow. 22 days on market only, down from 29, and 73% sold in less than 30 days. So basically what that shows is that if it's priced right, it's selling fast. People are buying things when they come to market and if they're priced right. So that's something to keep in mind if you're a realtor is that, definitely there's not a lot of inventory out there, but if you price it right, things are going to go fast, which is, good to see. The next thing we got was initial job claims we got today. This was a miss, basically it didn't come in as high as expected. So they're expected to come in at 254,000, only came in at 242,000. But there's some shenanigans going on here. So last week, it went up to 265 or so, but I guess there was a bunch of fraud in Massachusetts, which elevated those numbers. So still, if we go with the 4-week average, we're still about 244, which is a really high number. And the continuing claims is still above, right about 1.8 million, which is, again, a really high number. That's 1.8 million people are out of jobs and cannot find new ones. So we're going to have to keep a close eye on this. We didn't like seeing the lower numbers. But like I said, there was a little bit of a shenanigans with the numbers last week that made, this kind of blurb when it went a little higher and then come back down, but still elevated, still going up year over year. So we're going to have to keep an eye on that because like we talked about before, we know the Fed is keeping a close eye on all that. Purchase apps were down negative 4.8%, so almost 5%. Year over year, down 26%. This number is dropping because the year over year numbers are getting better, but still week over week, we're not getting better. And like we talked about before, this is directly tied to mortgage rates. Any volatility, mortgage rates are going up. We see this purchase app number go down. And like we talked about before, I don't want to talk about the refi number because that's still awful. Miscellaneous stuff. So, on Friday, what we got was University of Michigan consumer inflation sentiment. So basically how people feel about inflation. And this went up and the markets reacted really negatively to it. And just, a logical me outside all this data stuff. It just doesn't make sense to me. So, why would you react if people are taking inflation more seriously or were worried about inflation? That should be good for the markets, because, the worst thing would be people not caring about inflation. So that's just, I'll step off my, high horse, but I didn't get that one, but the markets definitely reacted negatively. And then over the last week, we're getting a lot of Fed speakers, a couple more tomorrow. I think Powell speaks tomorrow. So they keep coming out and talking and keep banging the drums of war on inflation, ignoring, looking at backwards looking data, talking all the talk and everything we talked about before. So we don't like to see that, but it's going to continue. And then so the average 30-year has ticked up to 6.7 from 6.49 last week. So bad week. Like I said, started with that University of Michigan inflation, continue with Fed speakers, and is continue with this debt ceiling drama. That actually might be a little bit higher. They haven't updated it, and I have a feeling that might tick closer to 6.75. So on the horizon, what do we got? We got we got PCE inflation on May 26th. We got BLS jobs. We got CPI on June 13th, and then we got the Fed again on June 14th. Right now, the markets is down to 66% no hike and 33% there'll be a hike. So we got to really hope. It would be really bad if they hiked again. We don't want to see that. We got to hope that some of this data that comes out starts to go our direction. We got to hope that they settle this debt ceiling thing here. I know the deadline's June 1st, but hopefully, they make progress and settle that this week. So again, no matter, how you think that's going to affect the mortgage rates, we just want it to settle down. We want things to get, less volatile. Right now, the spread between the average mortgage rate and the 10-year U.S. Treasury is over 3 points. Normally, that's only 1.7. So even if we just went back to normal times, we would be 1.3. So we'd be about 5.5 or so. The average mortgage rate, if we were just doing it with normal volatility. So if things just got back to, not being as crazy, maybe we'd be in the mid fives and not as high as we are now. So that's all I had for you guys this week. Like I said, not a lot of data out there, but a lot of narrative as usual. So if you need anything at all, please don't hesitate to reach out, and I'd be more than happy to help. Have a great day, everybody.